PetroTal, a stock that's trading on the stock exchange for not even $500 million, but according to independent experts, the reserves in the ground are worth $1.7 billion. That's a discount of over 70%. Sounds like the deal of the century, doesn't it? But there's a catch, and it's right in the middle of the Peruvian jungle. Welcome to Upstream number 15. PetroTal is a Canadian oil producer that is 100% focused on Peru, more specifically on the Bretaña oil field in the Amazon basin, Block 95. And that means they're not just some small explorer. PetroTal is the largest crude oil producer in Peru. The company is headquartered in Calgary, but its operational heart beats in the Peruvian jungle. Logistics is one of the biggest challenges. All the oil is transported by river barges. No pipelines, no roads. Everything goes via the river, and that makes PetroTal unique in the upstream world, but it also brings massive risks. In 2025, PetroTal produced an average of 19,473 barrels per day. That's about 9% more than in 2024 and totals over 7.1 million barrels in the fourth quarter. However, production dropped to only 15,258 barrels per day, and there is a specific reason for that. First, let's take a look at how I am invested here. In total, I hold 1,463 shares. My gain was 37 cents. Currently, I'm down 7%, and I have already received a net dividend of 34 euros. I compile all my data using InvestingPro. If you also want to use InvestingPro for your fundamental analysis, there is currently a flash sale with 55% off, plus with my community discount, you get an additional 15% on top. You can find the affiliate link below in the pinned comment. The 52-week high is between $0.35 and $0.72. Since mid-August 2025, PetroTal has had massive problems with leaks in the production pipes, so-called tubing leaks. Five wells had to be shut down. Production dropped significantly below capacity. It wasn't until October that a service rig was mobilized, and by early January 2026, 6 wells had been repaired. But that's only part of the problem. The guidance for 2025 was lowered from the original 21,000 to 23,000 barrels per day to 20,000 to 21,000. And now comes the really tough news. The 2026 guidance is only 11,750 to 12,250 barrels per day, and that's a decline of almost 40% compared to 2025. Why? PetroTal has terminated the lease for the Amazonia 1 drilling rig and is looking for a new contractor. That means the first new development well will be drilled no earlier than October 2026. Until then, only the existing production will continue and the natural decline rate will take its toll. Management makes it clear the goal is to get back above 20,000 barrels per day by 2027 with an 8-well program, but as of today, they are still far from achieving that. Let's look at the numbers. Revenue in fiscal year 2024 was $334 million. EBITDA was $215 million. That amounts to $36 per barrel. The last 12 months figures up to September 2025 show revenue of $311 million and EBITDA of $178 million. The decline is noticeable. In the third quarter of 2025, revenue was $63 million and EBITDA was $28.8 million. Net profit shrank to $3.6 million with a realized oil price of only $43 per barrel, while Brent was at $67. The discount is typical for Peruvian heavy crude. Operating costs are around $6 per barrel. That is extremely cheap. Added to this are royalties of $4.80, transportation of $3.36, and erosion protection at $3.91 per barrel. In total, about $24 all-in costs. And now the valuation, a PE ratio of 3.5 and an EV/EBITDA of 1.39. That's not cheap, that's absurdly cheap. The free cash flow yield is 31.6%. The book value per share is 57 cents. The share price is 53 cents in Canadian dollars. So, below book value. But it gets even better. The 2P reserves are at 114 million barrels, valued at around $1.7 billion. The market capitalization is just 351 million. That means the market is pricing in the reserves at a discount of over 70%. The balance sheet is surprisingly strong for a small cap oil producer. Cash position at the end of 2025, $139 million, of which $112 million is freely available. Total debt is only $101 million. That means PetroTal has more net cash than debt. That's rare in the upstream world. Operating cash flow was $231 million in 2024. CapEx was $163 million. For 2026, a CapEx budget of $80 to $90 million is planned, of which $45 million is for 2 Bretaña wells. The liquidity floor was set at $60 million in unrestricted cash. Conservative and reasonable. But, and this is the elephant in the room, the dividend was suspended in November 2025. PetroTal had previously paid out dividends regularly. The InvestingPro report even mentions a historical dividend yield of 22% here, but with declining production and an uncertain drilling campaign, the board pulled the emergency brake. For me, as a dividend investor, this is a double-edged sword. On the one hand, it shows discipline. They're not burning through cash. On the other hand, a key reason for investing is lost, at least temporarily. PetroTal is not a typical Peru risk. It is Peru risk in its purest form. The country has a history of political instability, social protests, blockades, and facility occupations. PetroTal was directly affected by this. Transport blockades on the rivers, production stoppages due to protests. On top of that, all the oil is exported via river barges. No pipeline, no alternative route. If the river is blocked, production comes to a halt, and this is an operational single point of failure that is more pronounced here than with any other upstream company in our series. PetroTal is trying to mitigate the social risk with a 2.5% social development fund from oil sales. This is a smart approach, but it is no guarantee against political unrest. In addition, there are exploration projects, Block 107 in the Ucayali Basin, and expansion at Block 131 with new TEs. This could bring diversification, but it is still in the early stages. Permitting and road construction are underway. PetroTal is an extreme case in our upstream series. On the one hand, there is absurd undervaluation, a strong balance sheet, low costs, and massive reserves in the ground. On the other hand, there are production problems, dividend suspension, Peru risk, and a 40% decline in the 2026 guidance. My assessment, therefore, PetroTal is a classic contrarian bet. If the new wells start producing at the end of 2026 and production rises above 20,000 barrels again in 2027, then this stock, with a PE ratio of 3.5 and reserves worth $1.7 billion, is an absolute bargain. But, and let me be very clear about this is not a stock for widows or orphans. This is a speculative position in a small cap oil producer with massive operational and geopolitical risks. The next earnings are on March 19th, 2026. The figures could serve as a catalyst or create further pressure. Just as on March 19th, the data for Energen will be released. On that day, I will analyze Energen in detail. Fair value according to InvestingPro is 60 cents, which implies a 53% upside from the current price, but only if execution is on point. As always, of course, this is not investment advice, but purely for informational purposes. Everyone is, of course, obliged to conduct their own research and due diligence. Personally, I think the stock is currently available at a relatively good price. Of course, there is a certain amount of risk involved, that's clear, but in my opinion, it definitely also has upside potential. If you enjoyed the video, I would appreciate a like here or a subscription if you don't want to miss any more upstream series. Otherwise, at the moment, shipping stocks are also super interesting, of course. I actually hold quite a few of them myself. I would even say that shipping is basically my main portfolio, or at least it's the largest in terms of allocation. Feel free to check out my playlist here. I'm sure you'll definitely find something interesting there. Otherwise, as I already mentioned, this is not investment advice. I wish you all successful investing, and I'll see you in the next video. Until then.